Hi, this is James Shugg of Westpac London with an experimental revamp of the end-of-day wrap for Thursday, September the 29th. In the US today, economic growth was revised up from 1% to 1.3% annualised, mainly due to higher estimate for services consumption and also a stronger net export result. In other news, we saw initial jobless claims, a measure of the extent to which Americans are being laid off, fall quite sharply in the latest week. It was down 37,000 to 391,000. Although the statistician cautions that issues related to the seasonal adjustment of those figures meant that the figures couldn't be relied upon as a decent guide to what's actually going on in the labour market. And that suggests that we should expect a bounce in that indicator to higher levels as soon as next week. Also on the labour market, and this was a real surprise to us, and so I'm going to read it because I hate reading it because it's not something I'm happy with. US statisticians have acknowledged that they actually underestimated employment growth by 192,000 in the year to March 2011, based on more reliable source data than the payrolls data that they use to calculate the figures each month. That's a real surprise to us because we've seen them a couple of months ago revise down their estimates for economic growth through that period. So it's odd that it took more workers than estimated to deliver less economic output than estimated through the year to March. So a surprise to us, and also an indication that productivity in the US is even weaker than is being captured in the official data. There will be revisions, more formal revisions published in February next year. That's just a preliminary estimate of the likely revision. In other news, pending home sales fell for the second month running. They were down 1.2%. And in fact, if you compare the level of sales in the last 2 months, that's July and August, they're down something like, 14% compared to the level of sales in the third quarter of 2009, which is when the US economic recovery allegedly started. So just like the story with new home sales, this measure of sales of established dwellings is way weaker now than it was at the start of the economic recovery 2 years ago. Further evidence that housing just isn't participating in the recovery in the United States. Also in the US, we had Charles Plosser of the Philly Fed dissent. He's one of the dissenters at the FOMC meeting, the last two in fact, explained his dissent. He said that that the Fed might be undermining its own credibility by creating the impression that recent policy tweaks, including Operation Twist, can have a major impact on the speed of the recovery. He thinks they can't. Okay, he's one of 3 dissenters at the last 2 meetings. Moving over to Europe, the German Parliament ratified passed its increased contribution, or the legislation required for it, to the European Financial Stability Fund. It's not actually money they pay, it's like a guarantee. It increased to more than 200 billion euros, almost €250 billion euros. The biggest contribution, of course, in Europe, and this has paved the way for eventual granting of the 6th tranche worth 8 billion euros to Greece, possibly as soon as next week. Still a few hurdles to get through, but this hurdle, the Greek parliamentary hurdle, has been passed. Also, it was a bit of a relief for Angela Merkel. Her own party backed her on this one. She didn't have to rely on opposition support to get the legislation through. Other European news, we saw the European Business Climate Index revised down sharply. Sorry, it wasn't revised down sharply, it fell sharply, as did the European Economic Sentiment Indicator, and consumer confidence revised lower as well. All of these indicators are starting to look like they looked during the recession year of 2008 in terms of the steepness of the decline. And in other news related to New Zealand, our friends across the Tasman, Fitch has downgraded the long-term foreign currency rating and also the local currency rating. The foreign currency rating from AA plus to AA and the local currency one from AAA to AA plus. They cited high net external indebtedness and a range of other considerations for that. So moving on to market movements, the favourable German parliamentary decision related to the expanded bailout fund and the decent US economic data, upward revision to GDP and the fall in claims, even though the claims number we don't think can be believed, has meant that the US market, the Dow's up 1.5% at 11,171, and we've got the broader S&P measure up about 1%. Because the Nasdaq actually didn't manage a gain today, so the tech stocks have weighed down the broader measure. That's at 6:10 London time. European markets are closed with the FTSE down 0.4% due to the full performance by the big commodity firms, but all the other European markets are higher on the German decision. So you've got, and also the US economic data. So you've got the French market up 1.1%, the German market's up 1.1%. As well, and some of the other markets are up even more, such as the Spanish market up 1.3% today. On commodity markets, it's commodities like gold and copper that are down, not a lot. I mean, gold's down 0.1%, copper down 0.2%, gold's at $1,616 an ounce. Oil is actually up 2.2% today. It's at $83 a barrel, and we've got sugar prices, I thought worth mentioning, for our Queensland friends, up another 7% today. They're absolutely soaring, as indeed are most soft commodity and food commodity prices. They have been of late. Aussie dollar is at, what's the Aussie at the moment? 97.55. It's a little bit softer, I think, with that the commodity news softening. That's holding the Aussie down, but not much change compared to some of the big moves we've seen of late. And actually, on that, we get a house price indicator for Australia tomorrow, and also the private credit numbers that the Reserve Bank publishes each month. So two guides to how the economy is faring, and we think that the case is slowly building for a rate cut from the Reserve Bank, probably by the end of this year. Okay, that's it for now. I'll be back, I think, with my usual format, because I don't like doing it this way, tomorrow.